We have a bit of show and tell for you today. This is the IssuesWatch podcast. Hello, and welcome to the IssuesWatch podcast. I'm Matt Charne, your host for this week's accounting and auditing episode. I'm an audit director at Clifton Larson Allen. Joining me today is Marissa Flood, assurance senior at CLA. Welcome back, Marissa.
Happy to be here.
This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. A quick disclaimer, the views and statements expressed herein are our own and not necessarily those of the NJCPA or of CLA. Okay, so I say that we have some show and tell today because we have a couple quick articles, kind of a light topic today, to just kind of cover some news that's been happening. So the first one that we have here is actually a proposal from the SEC that I found really interesting. And the proposal is saying they're going to allow public companies to kind of lessen the reporting requirements that they have on a frequent basis, so to speak. Yep. So for those that don't know, the way it currently works is every year you have to get your annual audit, which is your 10K report, right? And that is a 12-month audit. It's a lot of work. There are a lot of reporting requirements, obviously, because it's under the SEC standards and the PCOB will kind of comment on an issue and all those things, and it's a little bit more strict than just a U.S. gas audit.
Yes.
After that, and typically, if you work on public companies and you have this kind of background and experience, you know that you finish your 10K reporting, and you typically have a 45-day deadline if you're an accelerated filer, or a 60-day deadline if you're a large filer, or a 90-day deadline if you're an other filer. If you're in that other filer status, you kind of jump right into the next report because that'll be due about 45 or 60 days after your first quarter end, which is your first 10Q. And then you have 3 10Qs that you would issue throughout the remainder of the year, which are reviews that you would do under the SAR standards. And it is, in fact, a lot of reporting.
Yeah.
So what they're kind of proposing now is saying, well, instead of doing 3 reviews throughout the year and the audit, why don't we go down to semi-annual reporting? And it doesn't seem that they're quite sure on whether or not they're going to do an annual audit and a semi-annual audit, or a semi-annual review and the annual audit.
Okay.
And
yeah, I did read that it's
right.
it's still in the proposal phase, so they're still deciding on a few things, but
right. I have a few thoughts about that.
Same.
Right off the bat. But overall, that piece of it obviously is reduced just in the frequency of the reports that they're going to create.
Yeah.
And my thought is, if we go from a semi-annual review and an audit back from 3 reviews and an audit, that's obviously less work, right?
Yes.
Because you have 3 reviews and an audit and now 1 review and an audit. If we're going to do a semi-annual audit and a full audit, that's where I start to question if that's really less work.
Yeah, I would say client dependent. It could go either way, but
Yep.
I'm interested to see how that works because for now I feel like it's kind of similar. Like that would be pretty similar.
I would agree, because and my thought process for this is really the level of work that you would hit for an audit versus a review. And for a public company review, obviously you're still doing a lot of work, right?
Yes.
I'm not going to pretend that it's not burdensome and that there isn't a lot of cost involved in all this. But I wonder how much cost these companies would really save if we went from 3-month reviews and a 12-year audit to a 6-month audit and a 12-month audit. And it might lessen the amount of work you're doing in your 12-month audit because you can do some testing at the 6-month audit period. I would wager that most of these public companies that are doing these accelerated filings are doing tons of interim testing around the September, October timeframe anyway. So kind of just pushing that back to June almost cuts the amount of testing that they're doing down, so that you're doing 6 months of testing instead of 9 months, and then you're doing 6 months of testing at the year end instead of 3 months, when you know you have that really intense deadline coming up. So the amount of work that's involved in that is going to increase in that summer time frame anyway. And granted, you're a calendar year, of course.
Yeah.
And I wonder how much you're really going to save in accounting fees if you have the whole team coming in to do a ton of testing, as opposed to just having a few people come in and do some reviewing anyway.
Yeah, I really do see both sides of this. I'm almost leaning towards more of the negatives
Right.
of why this could. I think it's really great for the companies as a whole, but in my head I just keep coming from an auditor standpoint, I'm like, well, what if we get there at the mid-year point and there's a lot going on? There's some issues. There's mistakes of how something new was recorded. I just can't get past that little hump right now.
Right.
I think that's where I'm at.
Yeah, I mean, as auditors, it's hard to turn off that switch, so I definitely get that.
Yes.
I will play devil's advocate for the sake of the argument here and go with kind of a rebuttal to that point.
Perfect.
If you're a public company and you're used to getting these reviews every 3 months anyway, and the article even says this is to help maintain some tight internal controls, make sure those cycles are functioning and that stuff is getting recorded on time and properly as the year goes on.
Yes.
If you're used to doing that, and maybe you've been a public company for 4 or 5 years, just a random example, and everything is kind of flowing nicely, and you've got your 606 document set up, and you've adopted the new lease standard, and there's really not much new going on, at least not currently, just in this example. Why are you having your auditors come in to take a look at everything just to, give you a pat on the back and say everything's great, let's go out to lunch and let's head up?
And that I can definitely get behind where that is the positive on that.
Yeah. So what's interesting about this is the article says, and none of this is finalized, of course, but that the proposed change would give the companies the option to report semi-annually instead of quarterly. So if you're set up in a way that you feel really comfortable and you don't have a lot of adjustments in your audit, you don't have any comments in your management letter, that might be a good criteria to say, let's switch over from having you guys come every few weeks and check in on stuff, and let's just do the semi-annual report, and then our audit isn't normally that intense because we know what we're doing by the end of the year anyway. Yeah. So let's switch over to that. And the folks that do have a lot of adjustments and things that they might need help with, they would stay on that quarterly reporting basis.
Yeah, I agree. I think I was going through that point in my head a little bit too when I was reading this article. For me, this has been since the 70s that they've been doing quarterly reporting.
It has been a
going
while.
back. Yeah, we're going back quite some time. And so in my head, again, coming from the auditor standpoint, maybe a little bit you need to play devil's advocate here too. But
sure.
In my head, for me, the transparency quarterly is showing trustworthiness. Now, that's not to say that anyone who decides to go and do this semi-annual reporting and not choose the quarterly isn't trustworthy. It might, for a little bit, while this is getting amped up, the user transparency and the user's concern is where my head is going. Now, in a year, I don't think that, I think that it'll be fine and we'll see how it all lays out and users will be great. I just am still stuck there.
Yeah. So, again, I'll play devil's advocate on this as best I can and say, every financial statement user has their different opinion, right? And whether you're an investor, a banker, a customer, a partner company, a sister company, whatever it may be, and you're saying, well, I want to see that report every 3 months because I want to know what's going on, and I want you to be transparent. In our previous example, we were saying the folks that need to report more often are the ones that probably have a lot of mistakes and that they need their auditors to come in and kind of help them with the accounting. So if I see a company that has more frequent reporting, is that going to change and be a red flag and kind of an alarm bell for users and people who are in the market and say, well, these guys need to have their accountants come all the time and then look at all the reports they're doing, which means they must have a lot of adjustments and control comments and things. Maybe I don't want to put my money here anyway anymore and kind of back off from it. And I want to only invest and look at the companies that only do the semi-annual report because they know what they're doing and they don't need that much help. Yeah.
And it's funny, you just said that and then my eyes landed directly on the quote. So Paul Atkins, the chairman of the SEC, he said, giving the options to report semi-annually is not a retreat from transparency, and it's time to allow the market to dictate optimal recording frequency based on factors such as the industry, size, and investor expectations. So I guess that is, again, a conversation that they would have with their users and investors too, and go forward from there. So they definitely are thinking of all the things. I'm just in my brain also thinking of all the things.
Right. Yeah, it's definitely something to keep an eye on. I'm curious to see what the rules are going to be and how the comments come in and kind of react to it. It sounds like the proposal will be formally released at the end of 2025 or the beginning of 2026, so keep an eye out for that. We're not sure how long the comment period will be. If we catch wind of it, we'll certainly report on it and let you guys know and see what happens.
Yeah, I'm looking forward to seeing what comes up with this.
Absolutely. Yeah. So the next thing that we had, again, show and tell today, is a new tool that the NASBA had released on, I guess, comparing and contrasting requirements for using your license across state lines.
Yes.
Which is pretty interesting and pretty cool.
It is, yeah.
I think that can sometimes be a question mark for folks who normally practice in one area
Mhm.
and then maybe get an opportunity in another and are happy to jump into it, but then kind of pause and think, well, am I allowed to sign reports or returns in that area?
It definitely, I actually, so they redesigned CPAmobility.org, and I actually took a look at it last night, and it does,
Okay.
it lays out, there's a big map, and you
that's
can
fun.
click on the state, and it'll give you a whole rundown of the requirements and everything to practice in the state, so.
Right.
Um,
Yeah.
I mean, we are talking about new pathways and everything with the CPA, so I thought this would be a good thing to bring up and point out, just as
Right.
mobility increases across the states. And-
Absolutely. Yeah. And the first thing that jumped into my head when we saw this was remote work. You know, even in my field, I obviously sit in New Jersey and I work in New Jersey more or less every day.
Yep.
And my clients are sometimes in New Jersey, but oftentimes they're kind of all over the place.
Yeah.
And I will work with partners who are licensed in those different states, but it kind of begs the question, if I was the partner on that engagement and I was signing the report, I would probably have to check if my license was applicable in Texas or in North Carolina or in Florida or in Colorado.
Yep.
Or wherever that client may so happen to be incorporated.
Yeah, and it is funny that everything is more flexible nowadays, but I will say that it probably falls a little bit more on the CPA to stay informed, so this is a good tool to do that.
Right.
I would definitely go from that. And
Wonderful.
It's not just a tech upgrade.
Yeah.
Sorry, Matt. But
Well.
definitely shows like how we're evolving in the profession and everything, so.
Right. Yeah, I know we all like to have new tech upgrades and new toys to play with, but this does sound like a good tool to have in case you are doing remote work and, you know, making sure that you're crossing those state lines properly. I think we would find that, at least in our tri-state area, most of the requirements are the same, and states like to play nicely together and allow those requirements to kind of cross borders, but you never know.
Yeah.
So like you said, it's on the CPA to figure that out. In closing, here are some upcoming events you might be interested in. There's an annual FASB update and review webinar in the morning on November 24th, and there's a companion webinar that afternoon on recent AICPA standard setting. If you're interested in getting into forensic accounting, there's an intro webinar on November 25th. Get information about these events and more at njcpa.org/events. And of course, be sure to join the Society's Accounting and Auditing Standards Interest Group. Sign up for free at njcpa.org/groups. Thank you for watching or listening.